Apple's the company that people are going to attach themselves to for a long time, especially with Warren Buffett buying. So let's go analyze the stock right now using our software. So let me pull up Apple through our 8-pillar process and how we evaluate companies. As you can see, Apple's up a lot today, 145. On September 1st, it was 158. So down to 7 or 8%. That is fine. So pillar number 1, we want the 5-year PE on Apple to be less than 22.5. Right here, main page, it is 33. And that's an X. Okay, so a little bit higher than we want. Not necessarily a avoid, but higher than we want. Pillar number 2, we want the 5-year return on invested capital greater than 9%. It is currently 35.3%. That is incredible. That's a huge number. This says they do a great job of getting returns on the money that's invested in the business through debt and equity. Pillar number 3, very simply, what do we want? Revenue growth. So we go to our income statement. 5 years ago, we had $255 billion in revenue. Last year, $387. That's a check mark. So this huge company keeps getting huger. That's not a word, but you know what I mean. It's amazing out there. Pillar number 4, we want net income growth of the last 5 years. So we scroll down just a little bit on our software. We go to net income, $56 billion to $100 billion. Another check mark. Guys, this company prints money. And if you look at the way Warren Buffett has not said what price he wants to buy Apple at, but he has been buying Apple as it goes down. I think he's buying it under 140. Why is he buying it? He loves the moat that is Apple. Apple is a huge moat with a high return on invested capital. Him and Charlie Munger love those two attributes. And the high return on invested capital probably is what shows them they have a high moat. Pillar number 5. Now, guys, this is the silent killer of investing. This is something that nobody ever looks at, and that's why I'm glad you found this channel. So you need to subscribe to our channel right now. Just click the subscribe button because we look at investments in a way that other people do not. We don't follow hype. We look at it, buying a company, buying a stock as buying a piece of a business. And this is what you need to understand. So on pillar number 5, it's the shares outstanding. We want them staying the same or going down. Why? Because if companies issue more shares, they're diluting you as an owner. As an example, if a company has 10 shares outstanding and you own 1, you own 10% of the business. If they all of a sudden issue 2 more shares, there's now 12 shares outstanding, but you still only own 1. So now you own 1 out of 12 shares, which is 8.33%. You've been diluted from 10% down to 8.3%. So we go to the bottom of our income statement. We go to the end of the 6th year, $20.78 billion down to $16 billion. So they are buying back shares. Now I will say this. Apple has been pretty expensive in the last few years, so I'm a little concerned about why they're buying back shares, but we'll get into that in another video. Pillar number 6 has to do with debt. Debt works in a company the same way it works for you individually. The more debt a company has, the more likely it'll have financial problems when things start to slow down. It's easy to make a lot of money and have a lot of debt when interest rates are low and the economy is booming. So what's a reasonable amount of debt? Well, for me, in our 8-pillar process, I go back to our main page. I go to our 5-year average free cash flow. In this situation, it's $78 billion. I multiply it by 5, and that is $390 billion. Is that correct? Yeah, I think so. So we want their long-term liabilities to be under $390 billion. So where do we find that? We go up here to the balance sheet. We scroll all the way to the bottom. Total long-term liabilities, $148 billion. Well below the 390, half the number. That means they can pay off their long-term liabilities with just 2 years of their 5-year average free cash flow. That's pretty incredible. Now, pillars 7 and 8 have to do with free cash flow. So what is free cash flow? It's cash from operations less your capital expenditures, okay? This is the lifeblood of the business. It's a lot harder to manipulate free cash flow than it is to manipulate earnings. Earnings are affected by SEC rules, accounting rules, all these different rules. Free cash flow has a lot of restrictions as well, but it's much harder to fake that number, okay? So there are 5 things you can do with free cash flow. Buy back shares, pay a dividend, pay down debt, reinvest back in yourself, and make acquisitions. A company can do all 5, one of them, none of them. It can do any combination of those, okay? So on our software and the cash flow statement, we actually make it easy for you, and we add this free cash flow line to do the math for you. 5 years ago, 60 billion in free cash flow. Last year, 107. Check mark there. Okay. So that's another check mark. Our final metric is similar to the 5-year PE. We want to see what the 5-year price of free cash flow should be based on their free cash flow. So the market cap that will drive that. So we look at the 78 billion 5-year free cash flow. We multiply by 22.5. This will give me the market cap I need to be under in order for our price of free cash flow to be less than 22.5. So 78 is 1.4 trillion plus another 140, 1.5. So we'll call it $1.55 trillion. That's the market cap we want for the company, okay? So we go back to the main page, and the current market cap is 2.35 trillion. So that's another X. Now, I just did a lot of math for you, but we have our 8-pillar tab right here that does it all for you. Now, guys, look at this right here. We have check marks in everything except for the valuation metrics. So does that mean you should avoid the company? Not necessarily. If a company is growing or buying back a ton of shares, doing all these great things that are driving up EPS, let's go look at analyst expectations. It'll show you. On our software, we have 46 analysts on here. This is the EPS growth for the next 5 years. Not very fast, though. Mid-single digits. Okay, what about revenue growth? Again, low mid-single digits here. So it's not a fast-growing company. So in order to make your money on Apple, you've got to do it based on some sort of cash flow basis that's pretty conservative because the future doesn't look, and it makes sense. The company does $350, $400 billion a year in revenue. It's going to be hard for them to grow at a faster rate. So that's why we use the stock analyzer tool. This is the most popular part of our website. It allows you to make assumptions about the future on a certain company and tells you based on those assumptions, not including the balance sheet, what you should pay for the company based on those assumptions. So I recommend that as you watch this, rewind on the stock analyzer part because our software is so valuable here for the stock analyzer tool. You need to understand how we make our assumptions. So first thing I'm going to do is 10 years of analysis. First line, revenue growth percentage. The last 1, 5, and 10 years. But if you remember, our analyst estimates were not that high for the next 5 years. So I'm going to go with 6 on the high side, 4 in the middle, 2 on the low side. Now you might sit there and say, oh my God, that's so low. Maybe it is, but guys, it's a huge company. And our goal as value investors is to make conservative assumptions and then buy companies when they're selling below those conservative assumptions, okay? Now, profit margin. Profit margin has increased in the last 10 years. But with interest rates going up and the economy potentially slowing, I think profit margins are going to be held down quite a bit. So I'm going to go with a low side of 19, 20.5, and then 22. Free cash flow margin, I'm going to do, so they've basically been around 25 to 26%. I'm going to go 23, 24.5, and 26%. Now, PE and price of free cash flow. Now, guys, this is the hard one because you're going to get in a bunch of arguments. What's the right PE? What's the right multiple of free cash flow? This has a high return on invested capital, a very big moat. I think Warren Buffett and Charlie Munger are fine paying a very big multiple for this. What's your multiple? I don't know. But for me, I'm going to put 14, 16, and 18 for both PE and price of free cash flow. If you disagree with it, I get it. This is a very subjective aspect of the software. This is the most subjective. The one thing I do encourage you to remember is over long periods of time, the bigger and bigger the company is, the more realistic it is that the price of free cash flow will be on par with the market, which historically has been 15. Now, our final line here is what is your desired annual return? This is basically your margin of safety. You can get 9 or 10% by investing in a long-term ETF. So in order to get some sort of reason to buy an individual stock and have an ample margin of safety, you have to get higher than that. So for Apple, I'm going to put 12, 13.5, and 15. These are as I'm making higher assumptions, I want a bigger margin of safety because higher assumptions have more likelihood of not being right. So I want to put a higher margin of safety there. Now, guys, I'm going to hit the analyze button. When I hit the analyze button, 6 numbers are going to pop up. 3 of them are a multiple of earnings, and 3 of them are multiple of free cash flow, low, middle, and high for each. If it's all green, it does not mean go out and buy. It means go do some research here. Make sure these numbers are correct. Very simply, one way is to join the Everything Money community at everythingmoney.com, but go do some more research. Now, keep in mind, I don't know what Warren Buffett and Charlie Munger are looking at in terms of the price, but my guess is my price is probably a lot lower. Why? I have a lot less capital. Their goal is to preserve capital. They have so much money out there, it's hard for them to find big companies to deploy it in. So I think they're going to be okay getting a lower return on Apple. So I hit the analyze button. All right, guys, low side, I have around 60, high side, 80 to 90, middle, somewhere in the 60 to 70 range. So I add it to my watch list. I have it at 125, so I can go do more research at that point. So guys, again, this video was awesome. We do a lot of videos like this. We will be the ones talking about how great the market is as it falls. So make sure you subscribe to our channel. Thank you very much for your time.